Recently over on my Instagram, I was asked over 50 trading related questions to answer on my YouTube channel, so let's get into it. First question is, do I consider old session highs and lows as valid liquidity sweeps? The answer is yes. Let's go through some examples on the chart, shall we? So let's have a look at this example here. We have in this purple box, Asia session, just here. And then we have London session here. And we have New York session here. Now this is in a higher time frame downtrend, and utilizing ranges, we can see that we were still very much bearish. So we'd like to use range-based liquidity to help us with, again, break one to the upside, likely just a run on liquidity here, rather than it being a shift in trend to the upside. It was just a liquidity grab. But if we have a look at the session highs, what price has done is it's taken Asia highs here during London and didn't commit. But then what New York did was New York took London highs and then reversed. And this was the entry here after the retrace candle. Stop loss coverage above the high to the left. And you can either go a 1 to 2 or a 1 to 3 risk to reward. So you can see manipulating the highs in a bearish trend is very common, just as in a bullish market, manipulating the session lows is also just as common. There's another example actually the next day where, again, we are still very much in a bearish market. The final bearish range is this one, which also happens to be Asia highs. So we can see here Asia highs. London is inside of this, but there's a lot more resting liquidity above Asia. So what does price do during New York? Takes the highs. We have a break one to the upside, which ends up just being a liquidity grab again. And this was another trade I took live in my actual most recent vlog. I actually vlogged both of these trades. This one I was in with around a 14 pip stop loss. So it was around here. And then this one got me out for a 2 to 1. So there's a few examples of how you can use range-based liquidity, and we do that in evolution markets, absolutely. Second question is, what are the Killzone timings for indices? Well, it's the same as Forex for me. So I use 8 AM till 10 AM UK time for London, and 1 PM till 3 PM for New York session. These are both UK times. This is where you'll find better or increased volatility, and it also allows for a better work-life balance because you know when to look for trades and you know when to walk away and do something else. Next question is another technical one. So what is B1 and B2? So this is a formula that we use at the power of 2 to distinguish the difference between a liquidity sweep and a shift in new trend. B1 is often a sweep of liquidity, whereas B2 can be used to identify a continuation based on a new direction, giving us a mechanical rule for a change in new trend. B1 is simply a singular run on a high or a low, which often tends to be a run on liquidity. A B2 is a consecutive new higher high or new lower low, and is a confirmation rule for a shift in new market direction or the beginning of a new trend. I'll give you some chart examples. So let me show you an example of what I mean by break one, break two. First of all, we can see here we're quite clearly in a bullish market, printing higher highs and higher lows. If I zoom in here to the most recent bullish range, which was this one here, I require this low to be taken first, and I'll mark as B1, break one to the downside. So if I play this forwards, and you see we get that. So I'll rein this in. You can identify this as the final range that we had. Now, for me to consider this a bearish market, because this could well continue higher, following that higher time frame bullish trend. But if it goes and takes a new low again, breaking this, then I would consider that a new trend to the downside. So I will mark on, at this point, a potential B2, and it will be confirmed as soon as we get it. There we go, rein that in. And you can see also now, we've got a sequence of lower lows, and in between that, also a lower high, meaning statistically, this is more likely to continue in a bearish market. There's an example of B1, B2. Next one is, why don't you release a signals channel? Well, I prefer to teach traders how to become self-reliant rather than having to rely on me for a signal. I mean, I could be here today and gone tomorrow, then what would you do? You know, you need to be able to become self-reliant for your own trading, for your own life, your own decisions. I could teach you that strategy to follow, and then it's up to you to follow through with that. Next one was from a good friend of mine. What was the defining moment for you when building your strategy, your aha moment? So I wouldn't really put it down to one, but I'll pick the top 2 or 3. First one is having set rules to follow, especially based on identifying trend or market direction on the higher time frame, and that gives us a bias for the day. That's really crucial. So whether you've got a daily or a 4-hour bias, you know that you're either long or short, and you're not looking for both sides of the sword. Second one, I would say simplifying the edge to a point where you can actually say it verbally out loud to someone without looking at a list just to check if you've got it right or wrong. So knowing it like the back of your hand almost subconsciously, and being able to explain it in under 30 seconds is really crucial. And then the last one is knowing that it's okay and it's important to know when you can or should refine a strategy to improve it. Because I feel as a trader, we should always be striving for greatness. I'm certainly not at my pinnacle now, and I don't think I ever will be, because I'm always moving the goalpost. I'm always looking to improve, whether it's in my own technical trading or my self-development, my time management skills, my financial literacy. All of these things, including my trading edge, is always going to improve over time. Next one is, did you overcomplicate the strategy in your latest video? It doesn't seem that easy. So I would say it's only one video, so you're probably not going to nail down an entire edge or strategy just from one 30-minute YouTube video. It's also a watered down version because the community get the full 52-minute long video plus workflows. And that's where the value of the mentorship is, right? So although I'm putting stuff on YouTube to help people that perhaps can't afford it or are interested in knowing what it's all about before they sign up, but the mentorship's really where the source is. The ability to watch me live multiple times each week in the Discord, the ability to ask me questions as and when they come, the ability to follow my morning and afternoon outlooks, my market updates and my end of day reports. That's where the value is, and that's where you'll learn a strategy. You're not going to be able to learn a strategy even from a 30-day point. Even if it's the simplest strategy in the world, you definitely won't learn it from one YouTube video, otherwise everyone would be doing it, right? So maybe go back and watch that video a few more times, and then if you've got any questions, feel free to reach out to me on Instagram. Next one is best and legit prop firms. So I haven't really used an awful lot of prop firms, to be honest, but the ones that I have used without issues are the OGs, FTMO, been using them for a long time, still have accounts with them. And I've also used Finitive Funding, not had any issues with them. I think they're good guys. If you're looking for an A-book firm, however, then check out Top Funder, who actually offer a free trial whereby you can transfer up to 5% of your free trial profits into an actual live challenge account, meaning it brings down that 10% challenge profit target from 10 down to up to 5%. And you can take a free trial every 7 days. It's a no-brainer. Link is below for that, by the way. Next one's an interesting question. Thanks for submitting this one. This is a formula for finding the entry price of big players that all retail traders keep silent about. Wasn't too sure on what you meant by that, but what I think you mean is when the institutes are placing their orders. Now, my answer to that is we don't know where the big boys are entering the market exactly, but they do tend to place positions based on a higher time frame. They're not on the 1 minute, they're more on the daily and above. And they will seek out liquidity where most retail traders place their stops. So have a look at obvious liquidity points, say on the 4-hour chart, and wait for price to get there and see how price reacts. This is why we use B1, B2. B1 is a run on liquidity until we get B2, a continuation showing a shift in trend. If we just get a B1, a break one of a range, especially on a higher time frame, because it doesn't happen all that often, it does tend to be a run on liquidity, especially if it's a sell side liquidity break in a bullish market or a buy side liquidity single break in a bearish market. It tends to be liquidity. So mix this theory with higher time frame trend, and that should be a recipe for success. Next one is a technical one again. How do you analyze the market and what time frame do you execute your trades? So I see the 4-hour as the key driver, and using break 1, break 2 to identify a new trend, or B1 simply as a run on liquidity for continuation of that same 4-hour trend. I do sometimes often use the daily just to have a look as an extra confluence, but like I say, the 4 hour is the key driver. And then I just use the 15-minute time frame to mark out my ranges using a simple box tool and make sure that my trend on the 15-minute aligns with the trend on the 4 hour. Then simply for entry, I'm waiting for a 15-minute liquidity sweep and an entry during Killzone, like I mentioned in the first question, and a retrace candle. Then I'm using a 2-to-1 or a 3-to-1 RR typically. Simple as that. So if I come back to the previous example where we left it off, we had the final bullish range here, which broke once to the downside initially, and then it went and broke a second time, giving us B1 and B2 as we call it, which is confirmation for us as a new higher time frame market direction or a change of trend to the downside. So we're now looking for sells. This leg here is our current bearish leg, our range. And if we go to a 15-minute, we can look for range-based and session-based liquidity. So we can see where we are right now. Quite simply, we are inside this range, which is the 4 hour range and the 15-minute range, because we didn't create a new low down here. And quite simply, we move from the left all the way to the right, and we can note, takes all of this buy side liquidity, internal range, takes Asia and London sessions as well, and then we get our entry around 12 to 14 pips and a 1 to 2 RR, play that forward, and that's the trade idea. Sometimes it will take external range liquidity, other times like this it will take internal. Internals tend to work better when we have a larger external range like this, whereas smaller, tighter continuations, it does tend to take our 15-minute external range liquidity. There's more entry examples on my vlogs if you go back the last few weeks and have a look. I do run over trades quite often in my day in the life vlogs. Go check them out. What's the most important thing you must have or know before entering into a live market? So more of a psychological one, this one. A very good question. I would say, do you know your edge? Again, I mentioned it earlier in the video. Can you explain to a complete stranger in less than 30 seconds without reading it out from somewhere written down what your edge actually is an important one. And that takes time. Do you have proof of concept? Have you back tested it? Have you collected enough data to suggest that it wins 4 or 5 out of every 10 trades, for example? You know at least what your back testing strike rate is. And then you can reduce that accordingly for a live market situation, because your back testing results are not going to be an exact replication of what a live market is going to be, because you can use bar replay and TradingView and get through a month in 45 minutes. Whereas a month in real life is a month. You've got 4 weekends in there. You've got kids, work, lots of stuff in between, right? I mean, it takes 15 minutes for a 15-minute candle to close, but you can get through 15 candles in less than 15 seconds, right? So backtesting is simulated, it's very different, and it's almost without emotion. So if you've got a 50% strike rate in backtesting, then you're probably going to have a 40% strike rate in live market, right? So just taking that with a pinch of salt. But having that proof of concept is important. Plus, backtesting your edge builds confidence, and it builds a subconscious thought process behind what your edge actually is. And then also keeping a level head. Don't let your emotions get the better of you, and know that it's going to take time to master it. It's not a case of joining a mentorship 30 days in, 30 days out, and you think you've cracked it because you've watched the videos a few times. It takes a lot more time than that. Even again, the simplest of strategies, I would dedicate at least 3 to 6 months before you move on to something else. Even if that's not learning from me, go join a mentorship and stick with it for at least 6 months before you can say, I've committed enough time to this craft and to this strategy before I've decided it's not for me or it's not working. And then the last question is probably the best question. How quickly can you count to 10? Go. Right. Well, I'll count to 10 as quickly as I can if you go and subscribe to my channel at the same time. Ready? 3, 2, 1. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There you go. That was pretty fast. Thanks for watching. And by the way, to win a free Forex mentorship with myself and Evolution Markets FX, please comment below your best question and answer, your biggest key takeaway from this video, and I'll announce a lucky winner in the next 72 hours. Good luck, thanks for watching, and I'll see you on the next one.